Welcome to the deep dive. Today, we are targeting a really essential piece of the global financial plumbing, Fair Isaac Corporation. You almost certainly know it by its brand name, FICO. Think about it when you apply for a loan, check your credit, get a mortgage. That three-digit number, it's almost always FICO. It's the benchmark, the gold standard. It underpins, well, trillions in consumer credit. Our mission today is pretty clear. We want to cut through the noise, give you a really deep but fast understanding of FICO's, frankly, unique business model, its elite financial setup, and this really market-shaking strategic move it just made. It's fundamentally changed the whole U.S. credit scoring game.
Yeah, it's crucial to get that FICO isn't just another company. It functions really like a utility for the whole financial world. Its core product, that algorithm, it's the standard way to measure consumer credit risk. Pretty much every major lender speaks FICO. That makes it indispensable,
Well,
deeply, deeply entrenched.
And that entrenchment, that's key to understanding just how profitable they are. The business itself, it's built on this dual model, two main segments, quite distinct. You've got the historical powerhouse, the Scores segment, and then there's the strategic future, the software segment.
That's right. The Scores part is, well, it's this high-margin royalty machine built on that one dominant algorithm. But the software piece, that's FICO trying to pivot to become a bigger player in enterprise decisioning, moving beyond just the score itself.
Right, trying to automate complex stuff for big banks and financial institutions.
Exactly. End-to-end operations.
So the story we're unpacking today is how this company built on this incredibly lucrative, asset-light royalty thing, how it's managing this huge internal shift towards software.
While at the same time fighting off a major threat to its core business, the very thing that made it dominant. And that recent fight, well, that's where things get really interesting. Okay, let's dive into that Scores segment first. This is the engine, right? The foundation of FICO's elite financial status. It runs on a royalty model, and understanding how that works is really important, especially because, well, FICO doesn't own the raw data.
That distinction is absolutely critical. Think of FICO as the chef with the secret recipe, not the supermarket owner.
Okay.
The big three credit bureaus, Experian, Equifax, TransUnion, they own the massive databases of consumer information. FICO provides the algorithm, the predictive secret sauce. So when a lender, say a bank, needs to check your credit risk for a loan, they pull your report from one of those bureaus, and FICO gets a royalty fee because its score is attached to that report pull.
So FICO's basically cashing in on its intellectual property one transaction at a time. What about that fee? Is it like a fixed price, or does it vary?
Right.
Oh, it's complex, often negotiated. But historically, FICO has held most of the cards, the pricing power, because its score was often mandatory, especially in mortgages. And crucially, the bureaus act as the distributors. They bundle FICO's royalty into the price they charge the lender for the whole credit report.
Okay.
But because the FICO score is usually the most critical piece for that underwriting decision, FICO has immense leverage over the bureaus. They can demand a very high margin royalty for each pull. And this system, these transactional royalties, it's incredibly profitable, especially in the B2B channel, business to business, where lenders are constantly pulling scores.
And the recent numbers from that B2B channel, they've been pretty staggering, haven't they? Not just steady growth, but like acceleration.
Acceleration is exactly the word. Fiscal year 2024 saw really impressive revenue growth in B2B scores, but the momentum just kept building into 2025. And then Q3 2025, B2B revenue just surged, an eye-watering 42% year over year.
42%. That's the kind of number you expect from a hot startup, not a decades-old established company like FICO. How do you even break that down? Was it just more loans being made, or was FICO really flexing its pricing muscle?
It was both, really, working together. First, yes, we did see mortgage originations pick up. More loans means more score pulls, naturally.
Okay.
But arguably the bigger driver was the second factor.
Yeah.
Significantly higher unit prices. FICO was absolutely using its pricing power during that period. That fee per pull, which varies but can be anywhere from cents to dollars, they clearly pushed it higher. And that drove massive revenue growth almost independent of the broader economy.
And you compare that to the B2C side, consumers buying their own scores on myfico.com or similar sites. That was much more modest, right? Like 6% growth in Q3.
Yeah, much more modest, still growing, but it really highlights it, the B2B engine, that utility function for lenders. That's the real cash cow.
Okay, so this incredibly profitable engine, it must be well protected. You mentioned an economic moat. Let's talk about that. What makes it so hard for competitors to challenge FICO?
Right, the moat. It's built on, I'd say, three really strong pillars. These are structural advantages that make it very tough for anyone
All
else.
right, let's get past the buzzwords. What are these pillars in reality?
Okay, pillar one, lender adoption and just deep operational entrenchment. FICO is effectively the common language for credit risk. Estimates around 90% of the top U.S. lenders use it. Think about what it takes for a big bank to switch scoring models. It's not just changing software.
No, I imagine it's huge.
It's massive.
Yeah.
They spent decades building their internal risk models, pricing systems, everything, all calibrated to expect a FICO score, like a FICO 8 or a FICO 10T. Changing the score means rebuilding all those models, retraining thousands of people, getting new regulatory approvals, the cost, the time, the sheer operational friction. It's enormous. It basically locks them into using FICO. The whole industry relies on that consistency.
That lock-in sounds powerful enough, but then Pillar 2 adds like a government guarantee on top, the regulatory and GSE entrenchment.
This has been arguably FICO's trump card for decades. The GSE's government-sponsored enterprises, think Fannie Mae and Freddie Mac,
Right.
they historically mandated specific FICO score models for any mortgage they would buy or guarantee. So if you wanted your mortgage to be part of that huge, stable, government-backed market,
You had to use FICO, no choice.
exactly, no choice. This cemented FICO's role. It wasn't just preferred. It was required for the biggest part of the consumer credit world to function. This gave them unbelievable pricing power in their most profitable area for over 20 years.
Wow, okay. And the third pillar.
Pillar 3, consumer brand recognition. For millions of people, FICO is credit score. They're basically synonyms.
Sure.
This widespread consumer awareness and trust, which FICO actively cultivates through sites like myfico.com, actually reinforces lender adoption. Lenders like using a score that their customers know and understand. It adds another layer of validation, making FICO the default.
So you put those three pillars together, the lender lock-in, the historical government mandate, the consumer brand, and the result is that incredible pricing power you mentioned.
Precisely. Because they're so embedded, so essential, they can consistently raise prices like we saw with that 42% B2B surge. And that gives them revenue growth that isn't totally dependent on how many loans are being made.
Okay, so the Scores business is this entrenched high-margin cash machine. But FICO isn't just resting on its laurels, right? They have the software segment. This seems like their bet on the future, on diversification.
That's exactly the strategy. The Scores business is amazing, but it relies on third-party data and, as we'll see, regulatory goodwill. The software segment is about building future growth that FICO controls more directly.
So what's in this software segment? Is it just one thing?
No, it's a suite of tools. It includes some very successful legacy products, actually, like FICO Falcon Fraud Manager that's been a leader for years, protecting billions of payment cards worldwide.
Okay, I've heard of Falcon.
Yeah, it's huge. But the real strategic push, the focus now, is on the FICO platform.
The platform. Let's define that. What does it actually do for a big bank? Is it just software in the cloud?
It's more like, think of it as an integrated operating system for making decisions, built specifically for the cloud. Historically, a bank might have, I don't know, dozens of separate clunky software systems for different things.
Right, one for new accounts, one for fraud, one for collections.
Exactly, siloed systems. The FICO platform aims to bring all that together into one environment. It uses AI, advanced analytics, FICO's specialty, to pull in data from anywhere, not just credit reports, and then automate complex decisions at scale. So instead of having people manually review a million requests for credit line increases, the platform can process them instantly using FICO's risk models. That's the goal. Move from selling just the score, which is one decision point, to selling the whole system that automates sequences of decisions.
And about 140 major institutions are using this platform now.
Roughly, yeah. Mostly Tier 1 financial institutions.
And the way they make money here is totally different from the Scores royalty model.
Completely different. This is primarily recurring revenue. Think SaaS, software as a service subscriptions, plus some legacy license fees, maintenance, and professional services for getting it all set up. That shift to predictable, recurring subscription revenue is really key for investors.
Okay, so if they're making this big strategic shift from older software and transactional models to this new SaaS platform, how do we know it's actually working? What are the key metrics to watch?
You really need to look at the split between the platform metrics and the non-platform, or legacy metrics. It shows they're managing the transition pretty carefully. Platform annual recurring revenue, ARR, that grew a solid 31% in fiscal 2024, very strong adoption. In Q3 2025, it was still robust, around 18% growth.
Okay, 18% is still good, but what about the old stuff, the non-platform ARR? You said that includes things like older Falcon versions.
Right, and that declined, but only by about 2% in Q3 2025.
Only 2%. That seems slow. If the platform is the future and presumably more profitable, why aren't they pushing clients to migrate faster, letting that legacy stuff linger?
Well, that slow 2% decline is actually quite deliberate, I think.
Mm-hmm.
It shows careful management of what they call cannibalization.
Okay.
Those older legacy systems, even if they're not the strategic future, are still very profitable for FICO right now. They're cash cows. If they forced everyone onto the platform immediately, they might upset major clients, push them away, maybe even towards competitors during that disruption. So that slow decline suggests they're successfully moving clients over time, probably as contracts renew or when it makes sense, while still squeezing profit from the old systems. It's a balancing act.
Got it. But the real test of the platform's health isn't just new revenue, it's how happy the existing customers are, right? That's where net retention rate comes in.
Exactly. Dollar-based net retention rate, DBNRR. This is critical for SaaS businesses. For the FICO platform, DBNRR is running at a very healthy 115%.
So what does 115% mean practically?
It means that on average, the customers who were using the platform last year are spending 15% more this year. They're not leaving, they're expanding. Buying more modules, using it for more processes, adding more users or territories. That's how FICO grows the software segment organically.
And the non-platform DBNRR?
That's below 100%. It
Yeah.
was 97%.
Yeah.
That confirms there's a small amount of net churn happening there, as expected, as customers migrate off or phase out the older products.
Yeah.
So the contrast is pretty stark. Expansion on the platform, managed decline off it.
And this isn't just about moving old software online. FICO's putting its deep AI and risk modeling expertise into this, right? Trying to build things competitors can't easily copy.
That's their edge. Their decades of experience in financial risk analytics is the differentiator in what's otherwise a very crowded market for enterprise software. A great example was the announcement in September 2025, the FICO Focus Foundation model for financial services.
Okay, generative AI models, they're everywhere. ChatGPT, etc. Why build their own? Why specifically for finance?
Because the requirements are different and the stakes are much higher. General AI models are great for, say, writing marketing copy. But for real-time fraud detection or calculating bank capital reserves, you need speed, accuracy, cost-effectiveness, and critically, auditability.
Auditability, meaning you need to know why the AI made a decision.
Exactly. Regulators demand it. If an AI denies someone credit or flags a billion-dollar transaction, the bank needs to explain why. General models are often black boxes, huge, expensive to run, and maybe not tuned for the low latency needed in finance. FICO's bet is that their specialized data science lets them build smaller, cheaper, more accurate AI models specifically for these financial tasks, models that are also transparent and auditable. That's a potential moat against the generic AI giants.
Interesting. And they're also updating the core score itself, trying to keep it relevant by adding new types of data.
Yes, that's a crucial defensive move too. The launch of FICO Score 10 BNPL. That formally brings in data from buy now, pay later loans.
Ah, like Klarna, a firm.
Exactly. BNPL is huge, especially with younger people. By adding this payment history, FICO keeps its score reflective of modern credit habits. It also helps with financial inclusion, potentially scoring people who mainly use BNPL and don't have traditional credit histories. They have to keep evolving the core product to stay dominant.
Okay, let's pivot from the strategy and products to the pure financials. Because FICO isn't just successful, well, it looks like an elite business model on paper. The profitability is kind of astounding.
The numbers really are remarkable. It performs less like a typical financial services firm and more like a high-margin tech or data company. Total revenue hit about $1.93 billion trailing 12 months. That's up almost 17% year over year, mostly thanks to that huge 34% surge in the scores segment we talked about. But yeah, the profitability metrics are where it gets really impressive.
Margins specifically. We expect tech companies to have good gross margins, but FICO seems to be on another level.
They really are. Structurally high margins. Gross margin is pushing 82% TTM. That reflects the fact that their main product is intellectual property. The cost of delivering one more score is tiny. Even more striking is the operating margin. It's expanded massively over the past decade. Back in 2015, it was under 19%. Now, TTM, it's around 45.9%. Almost 46%.
46% operating margin. That's territory usually reserved for like Visa or Microsoft or maybe some really hot sauce company. How does FICO sustain that kind of profitability discipline?
It comes down to the incredible operating leverage in that Scores business. The cost to serve the next customer, the next million score pulls, is practically zero. And because they have such strong pricing power rooted in that moat we discussed, they can maintain that discipline. It means huge chunks of revenue drop straight to the operating profit line. It's proof the moat is working, and this has fueled net income growth of over 21% compounded annually from 2015 to 2024.
Profit is one thing, but cash flow is arguably more important. How good is FICO at turning those profits into actual cash?
It's exceptionally good. FICO is a cash generation machine because its asset light doesn't need factories or lots of equipment, and the earnings quality is high. In fiscal 2024, they generated $607 million in free cash flow, FCF. That's a 35% FCF margin on revenue. But the really telling number is the cash conversion ratio, 118%.
Okay, explain 118%. How can cash flow be more than net income?
It usually signals very favorable working capital dynamics. Maybe they collect cash from customers very quickly or have minimal issues with inventory or receivables. It means the accounting profit is translating very efficiently into real cash in the bank, not getting tied up elsewhere. Plus, being asset light means they don't have to spend much on capital expenditures, CapEx. In FY 2024, CapEx was only about 4% of their cash flow from operations. They just don't need to reinvest much to keep the business running or growing.
So you have high margins, fantastic cash conversion, low capital needs. Put that together, and the return on invested capital, ROIC, must be pretty crazy.
Stratospheric is a good word. ROIC has climbed steadily and hit a remarkable 53% in the trailing 12 months.
53%.
Yeah, think about that. For every dollar of capital invested in the business, debt, and equity, FICO is generating 53 cents in profit each year. That puts it in a truly elite group of companies globally. It shows incredible capital efficiency and, again, the power of that moat.
Okay, so they're generating huge amounts of cash, more than they need to run the business. What does management do with all that surplus cash?
Their strategy is very clear, very consistent, and very aggressive. Give it back to shareholders, almost entirely through buying back their own stock, share repurchases.
Why buybacks instead of, say, dividends?
They see it as more tax efficient for shareholders. They actually stopped paying a dividend years ago to focus on buybacks, and they are aggressive. In fiscal 2024, they bought back $828 million worth of shares. That was 136% of the free cash flow they generated that year.
Wow, spending more on buybacks than they earned in cash flow.
Yes, it shows tremendous confidence in their future cash generation. They basically pre-spent future cash flow on buybacks. And they doubled down, authorizing another $1 billion buyback program in June 2025.
And the effect of buying back so many shares, it reduces the total number of shares out there, right?
Exactly. The share count has dropped dramatically from over 30 million down to around 24.3 million.
So what does that do to the earnings per share, the EPS number that investors watch so closely?
It mechanically juices it. This is the other part of FICO's financial engineering magic. Simple example. If FICO earns $100 million and there are fewer shares outstanding, the slice of profit belonging to each remaining share automatically gets bigger. That's why their EPS has compounded at an incredible 25.7% over the last 5 years, much faster than their actual revenue growth. The buybacks amplify the growth per share.
This aggressive buyback strategy, though, it creates a weird situation on the balance sheet, doesn't it? FICO reports a stockholders' deficit, negative book value of $1.4 billion. That sounds bad.
It sounds alarming, yeah. Negative equity usually screams financial distress, but for FICO, it's an accounting outcome, not a sign of trouble.
How can a company with 53% ROIC be technically insolvent on paper?
It happens when a company consistently buys back its stock at market prices that are much higher than the original accounting or book value of those shares. Each buyback reduces the total equity on the balance sheet. Do enough of it, aggressively, and equity can go negative. Think of it as management being so confident in future cash flows that they're effectively swapping today's accounting equity for tomorrow's higher EPS. It's a sign of confidence, not weakness, in their specific case.
Okay, that makes sense. So FICO's built this incredibly profitable cash-generating machine, protected by a strong moat, and using buybacks to boost shareholder returns. But things haven't been entirely stable recently. The competitive environment shifted dramatically.
Right. For years, decades really, credit scoring was this stable, profitable duopoly. FICO was king, and the only real challenger was VantageScore.
VantageScore. Who are they again?
VantageScore was actually created back in 2006 by the 3 big credit bureaus, Experian, Equifax, TransUnion.
Ah, the distributors.
Exactly. They created it specifically to challenge FICO's dominance and, frankly, its pricing power. VantageScore's big advantage was always distribution. The bureaus owned it, so they could push it to lenders. They also often claimed their score was more inclusive, scoring more people accurately.
But FICO held on to the throne.
Pretty much, largely because of that GSE mandate in the mortgage market. VantageScore made inroads elsewhere, but for mortgages, FICO was the standard. It was like a Cold War, but FICO had the ultimate weapon.
The regulatory requirement.
Until the regulator changed the rules.
Yeah.
This is the big catalyst, right? This is the earthquake. The Federal Housing Finance Agency, the FHFA, approved VantageScore 4.0 for use in mortgages bought by Fannie Mae and Freddie Mac. At the same time, they mandated an upgrade to FICO's latest model, FICO 10T. But the key was letting VantageScore into the GSE game. Implementation is set for Q4 2025.
So suddenly, FICO's biggest competitor is officially approved for use in its most profitable, most protected market. What did that do to FICO's relationship with the bureaus, who are both their distributors and the owners of VantageScore?
It completely upended it. Overnight, FICO's main distributors became its direct competitors in the lucrative mortgage space. The bureaus now had a huge incentive to push their own product, VantageScore, to mortgage lenders. The immediate analysis was grim for FICO. People expected them to lose significant market share, maybe 10–20% or more, and be forced to cut their royalty fees drastically to compete. It looked like a major blow.
The moat seemed breached. This looked like an existential threat. FICO had to respond. And the response in October 2025? It was bold.
Bold is an understatement. It was a decisive counterpunch. They launched the FICO Mortgage Direct License Program.
Direct license, what does that mean?
It means FICO turned the tables. Instead of relying on the bureaus to distribute their mortgage scores, bureaus who now had an incentive not to FICO said, fine, we'll sell our scores directly to mortgage lenders and resellers. They decided to bypass the bureaus entirely for this key market.
Why would lenders go for that? Doesn't it add complexity compared to getting everything bundled from the bureau?
FICO gave them a massive incentive price. They offered an average cost saving of 50% for lenders who signed up for the direct license.
50%? How could they afford that?
Because they were cutting out the middleman's margin. They were essentially saying, we'll give you, the lender, a huge chunk of the money the bureaus used to take as their distribution fee if you come directly to us. The strategy was brilliant, really. Strengthen direct relationships with lenders, leverage the powerful FICO brand recognition, get the real FICO score, maintain market share through a compelling price cut, and recapture profit that used to go to the bureaus. They used their pricing power defensively to block VantageScore and simultaneously grab more of the overall profit pool.
And the market's reaction? It seemed to instantly declare a winner in this first round.
Absolutely immediate and dramatic. FICO stock jumped 18% right after the announcement. Investors clearly believed FICO could successfully defend its turf this way. Meanwhile, Equifax and TransUnion shares plummeted, down 8% and 11%. The market realized FICO had just used its brand power to potentially steal a huge slice of the profit the bureaus thought they were about to gain with VantageScore's approval.
So the whole structure of the industry just changed. It went from that stable FICO VantageScore duopoly dominated by FICO to this dynamic, messy three-way fight between FICO, VantageScore, and the bureaus acting as distributors' competitors.
Permanently changed. FICO's betting its brand and its direct pricing can win out, even if it means lower per-score revenue initially because they capture all of that lower revenue instead of sharing it.
Okay, FICO's dominance seems intact for now, maybe even strengthened strategically, but no company is risk-free, especially one so central and profitable. What are the main risks we need to keep an eye on?
The biggest, most immediate risk is definitely competitive risk. That Q4 2025 implementation of VantageScore in mortgages is still the key date. FICO's direct licensing program has to work smoothly. If it's messy, or if too many big lenders find it easier to stick with the bureaus, even if it means using VantageScore sometimes, FICO could still lose share and see its pricing power erode. Execution is critical here.
Makes sense. What else?
Second is ongoing regulatory risk. You can't have a 90% market share and 46% operating margins without attracting constant scrutiny from antitrust regulators.
Right.
Any government action that limits FICO's pricing freedom, forces more transparency, or mandates alternative scores could really hurt the model. And specifically, they remain vulnerable to any future changes in FHFA policy regarding GSE requirements. That historical mandate was a gift, but it can be taken away or modified.
And the economy itself, cyclical risk. Their scores revenue depends on lending activity, right?
It does. While FICO has shown it can often raise prices to offset dips in loan volumes, a really severe and prolonged recession would be tough. Think back to the 2008 financial crisis. Mortgage lending basically collapsed. FICO's revenue actually fell by about 20% over 2 years then. So while resilient, they're not completely immune if the entire credit market freezes up. A sharp downturn could overwhelm their pricing power gains.
Okay, so there are risks. Yet despite them, the market gives FICO a really high valuation. You mentioned a PE ratio around 58x, price to free cash flow near 54x. That's way higher than the bureau's, way higher than FICO's own history. How on earth is that premium justified?
You're essentially paying up for quality, predictability, and that incredible capital efficiency. The market sees the durable moat, the massive margins, the 53% ROIC, and combines that with the proven EPS growth engine fueled by those buybacks. Investors look at FICO almost like a high-growth bond or annuity, a machine that can reliably churn out cash and boost EPS by 25% plus per year, often regardless of the wider economy. They pay a premium for that perceived certainty. But, and this is the crucial but, that premium valuation builds in enormous expectations. There's very little room for error. The market expects flawless execution on defending the Scores business and growing the software platform. Any misstep will likely be punished harshly.
So boiling it all down, for FICO to continue succeeding and justify this high price tag over the next few years, what absolutely needs to go right?
I'd say three things are non-negotiable. First, that direct licensing program for mortgages must succeed in defending market share. If VantageScore grabs more than, say, 15–20% of the GSE market, that's a major failure for FICO's strategy.
Okay. Defend the core.
Second, they have to keep executing on pricing. They need to continue demonstrating that ability to raise prices effectively, making revenue grow faster than loan volumes fluctuate. That 42% surge showed they can, but they need to keep doing it smartly.
Maintain pricing power.
And third, the software platform has to keep delivering strong growth. Those high ARR and DBNRR numbers need to stay high. That proves the diversification strategy is working, provides a second growth engine, and makes the overall business more resilient if anything ever does seriously impact the Scores segment.
Defend the core, maintain pricing, grow the software.
Got it. This has been fascinating. We really went deep, moving past just the score itself to see FICO as this complex, cash-generating machine navigating a major strategic shift and a competitive battle.
Yeah, I think the two takeaways that really stand out are that incredible 53% ROIC, just world-class financial performance, and the sheer strategic boldness of that October 2025 countermove. Faced with a regulatory threat designed to weaken them, they flipped the script. They bypass their distributors, cut prices to the end customer, and aim to consolidate their own power and profit share. It was quite something.
It really was. And it leads to this final kind of provocative thought we wanted to leave you, the listener, with. It's about those unintended consequences of regulation.
Go on.
The FHFA's goal in approving VantageScore was clearly to increase competition in mortgage scoring, probably hoping it would lower costs somewhere in the system.
Right. Break the monopoly, help consumers maybe.
Theoretically. But FICO's reaction wasn't just to compete on the bureau's terms. They bypassed the bureaus, offered lenders a massive 50% discount directly, and in doing so likely captured more of the total industry profit pool for themselves, while simultaneously hammering the stock prices of the bureaus who own the rival score. So the question it raises is, in an industry this entrenched, this essential, did the attempt to inject competition actually end up strengthening the dominant player's grip? Did it just shift the profit pool away from the distributors and potentially give FICO even more control over the ultimate price in the long run?
It's a fascinating question. Did the move designed to increase competition paradoxically consolidate power? Definitely something to think about regarding how these regulated essential markets actually function. Well, that's definitely food for thought. Thank you for joining us for the deep dive.